Here's our first problem. This is a Timberlake owns equipment with a cost of $165,000 and accumulated depreciation of $60,000 that can be sold for $82,000. So that's our first future item. Okay, we can sell it for $82,000, less a 6% sales commission. Alternatively, they can lease the equipment, so they've got something to get rid of. They can sell it, or they can lease it to someone else for 5 years for $84,600, at the end of which there is no residual value. In addition, the repair, insurance, and property tax that would be incurred by Timberlake on the equipment would total $79.50 over 5 years. Prepare a differential analysis as to whether Timberlake Company should lease or sell the equipment. Okay, so we have, you can make up a table that says to lease. These are options, or sell, and then we've got the difference. Okay, and we can look in the first place at the difference in revenues. If we lease it, we can lease it for $84,600. Okay, if we lease it, we can lease it for $84,600, or we could sell it for $82,000. Okay, $82,000. So our difference right here is $2,600. Okay, and we could say that that is, you know what, I'm going to use brackets. That is just go like this. Okay. Now, what other costs do we have? We've got, they tell us that it's going to cost us $79.50 over 5 years. And here we've got to pay a 6% sales commission. So 6% times $82,000 is $49.20. Okay? So the difference between these two is 3,000. Oops, 3030. Yeah. Okay. And the income or loss would be $76,650 if we lease it to somebody else, and $77,080, and hardly any difference at all. We've got a $430 difference between the two. Personally, I get rid of it. Okay, but that's how you would do it. Okay. Now let's look at a longer one. We're going to look at this D'Amato Corporation, and they are considering new equipment. And the equipment can be purchased from an overseas supplier for $315,000. Can purchase it for $315,000. The freight and installation costs are $15,000. So this is considering new equipment. Purchase it if purchased. Alternative, they can lease it. So this isn't a lease or sell. This is a lease or buy, which is the way you usually see these problems. Okay, or these issues at work. You know, to get into the leasing business when you really do something differently is sometimes a mistake. So I'm going to have a column here for lease, buy, and a difference column. So what's it going to be? We can purchase from an overseas supplier for $315,000. $315,000. The freight and installation costs of the equipment are $15,000. So this is a purchase price. And this is freight and installation, which would be part of the cost of the asset. If purchased, annual repairs and maintenance are about $12,000 per year over a 4-year useful life. Okay, so we're looking at 4 years. So 12,000 times what are these for? This is repairs and maintenance. And we'll say it's 12,000 times 4 years. That would be 48,000. Okay, and these are all cash outflows. 4 years. Alternatively, they can lease the equipment from a domestic supplier for $95,000 a year. $95,000 a year for 4 years. 95,000 times 4. 380,000. Okay, 380,000. Any other costs that they do with it? Prepare a differential analysis of 1 or 2. This is lease or buy, which must be analyzed from the perspective of the buyer. So we've got, if we lease it, it's going to cost us $380,000, and if we buy it, it's $315, say $330 plus 48. Got a cash flow outflow here. Again, a really close call. It's $378,000. So lease is $380 and buy is $378. The difference here is $2,000 between the two. So just based on the financial considerations, we would say that we would buy the equipment for $378. Okay. Plus, if you were going to use it for more than 4 years, you know, this would probably be the way to go. Like if the technology changes really fast, then you'd have something else to think about. I would not worry so much about filling this in, because to me these are two future things. I know. I mean, it's one versus the other, but this one works. Okay. All right.